Welcome to Stress-Free Investing Analysis Personal Notes. Today, we're unpacking what is, frankly, a chaotic, binary bet on Sudarshan Chemical. Just a quick look at the disclaimer on your screen. I am not a SEBI-registered research analyst or investment advisor. Investing in the stock market involves significant risks. The data and charts shown are based on public information and my personal research notes. Please do not treat this as a buy or sell recommendation. Always conduct your own due diligence or consult with a SEBI-registered professional before making any financial decisions. All right, here is our roadmap for this explainer. 1. The Heubach shockwave. 2. Standalone versus integration pain. 3. Red flags and governance risks. 4. The global pigment cycle. 5. Valuation, bull versus bear. And 6. The final verdict. Let's jump in and separate the noise from the actual data. Section 1, the Heubach shockwave. We're starting with some major dramatic tension right out of the gate. Look at the sheer scale. By acquiring the 200-year-old German company Heubach Group, which was a distressed asset for roughly 151.9 million euros back in March, Sudarshan transformed into the number 3 global pigment manufacturer literally overnight. Their trailing 12-month revenue essentially tripled to roughly 8,347 crore rupees. That is a massive, massive leap. But here's the catch. Swallowing a distressed asset of that size requires serious capital, and they had to take on heavy leverage. Their debt surged from just 467 crores in early 2024 to a staggering 2,528 crores. That's more than a 5x increase in 18 months, completely transforming their balance sheet. And for regular investors, this chart right here illustrates the gravest consequence of funding that deal. The Rothi family's skin in the game has virtually collapsed. It went from almost 36% down to just 8.2%. Because they issued massive equity through rights issues and QIPs, the promoters now have minimal economic alignment with us, the regular shareholders. It's a huge governance shift. Section 2, standalone versus integration pain. To really wrap our heads around this, we have to look at the core engine versus the heavy anchor they just picked up. Think of this business as having a split personality right now. On the left, you've got the highly profitable, cash-generating Indian operations. They're pulling in a healthy 13% EBITDA margin with a massive 35% domestic market share. Awesome, right? But on the right, you have the severe integration pain of Heubach. It's operating at steep losses with an absolutely bloated 507-day inventory. And here's the really scary part. This loss-making portion of the business now makes up roughly 67% of their overall revenue profile. The healthy legacy business, only 29%. The tail is effectively wagging the dog here, dragging down those consolidated margins. You can see this integration pain manifesting immediately in their cash flow. They are in a severe working capital crisis. Working capital days surged from 40 to 154. Cash is just bleeding out and getting trapped in unsold European inventory. To put that in perspective, their cash flow from operations compared to their EBIT now collapsed to just 10% in FY25. Section 3, red flags and governance risks. Okay, I know, it's a bit ironic for an explainer based on stress-free investing notes to talk about 10 distinct forensic red flags, but we have to look at this objectively. Let's rapid fire through the top 3 absolute critical warnings. First, an unresolved auditor qualification regarding unauthorized asset transfers at a subsidiary. That demands your absolute maximum caution. Second, a Beneish M-Score sitting at minus 0.8. That crosses right into the earnings manipulation zone. Now, it's likely due to the messy M&A integration, but it's still a massive flag. And third, management slashed their Heubach EBITDA guidance by 54% in just 6 months. Then we have the Altman Z-Score. For those who don't know, this is a well-known formula that predicts bankruptcy risk. Sudarshan Chemical currently has a score of 2.24, which puts them squarely in the gray zone, approaching financial distress. Sitting in this zone proves they have zero margin for error in executing this turnaround. Section 4, the global pigment cycle. So, with all those terrifying metrics, why do it? What was the strategic logic behind buying this distressed asset? Well, management timed this acquisition for what they believe is the absolute bottom of the global pigment demand cycle. They're betting on an imminent macroeconomic rebound. As they noted, global accounts are finally resuming buying. The logic is simple. You buy a massive asset at rock bottom, effectively recognizing a 1,243 crore bargain purchase gain on paper, and then you reap the rewards when the cycle turns. Check out this timeline. We had severe destocking and high interest rates for years. Then they acquire Heubach in distress. Now, if the European Central Bank cuts rates and inventory destocking finally ends, we could see a massive volume recovery by FY27. That suddenly validates this entire deal and potentially turns those heavy losses into a cash printing machine. Section 5. Valuation, bull versus bear. This brings us to the core thesis. Sudarshan Chemical is no longer a standard, predictable compounder. It's a high-risk, binary turnaround bet. The risk-reward here is totally asymmetric. Look at the scenarios. Base case, 50% probability, gives you a modest 17% upside. But the extremes are wild. You have a 30% chance of the bear scenario playing out, dropping 36%. But if the synergies click and the cycle recovers, the bull scenario offers an incredible 91% upside. But it all boils down to this one ultimate metric. Can management achieve 90 to 100 million euros in Heubach EBITDA by FY28 or 29? Hit it, and the stock re-rates massively because they bought it so cheaply. Miss it, and that debt spiral gets really, really ugly. Section 6. The final verdict. Let's pull all this complex analysis together into a clear takeaway for your portfolio. The verdict? Speculative buy, and I really emphasize high risk here. This is not a buy and forget value investment. It requires a very small position size, 2 to 4% max. Absolutely do not average down blindly. You need a strict hard stop loss at 650 rupees, and you have to stomach massive volatility. Watch those Q1 FY27 results like a hawk to see if that EBITDA actually starts recovering. So, the ultimate question is, are you willing to stomach short-term pain for the chance of a massive cyclical payoff? Before we wrap up, a quick but important disclaimer. The analysis shared in this video is for educational and informational purposes only. I am not a SEBI-registered research analyst or investment advisor. Investing in the stock market involves significant risks. The data and charts shown are based on public information and my personal research notes. Please do not treat this as a buy or sell recommendation. Always conduct your own due diligence or consult with a SEBI-registered professional before making any financial decisions. If you found this deep dive helpful and want to stay updated with more stress-free investing analysis, please hit the subscribe button and press the bell icon so you never miss an update. I want to hear from you. Which Indian-listed company should I analyze next? Drop the stock name in the comments below and it might be the subject of my next video. Thank you for watching and keep your investing stress-free investing.